Okay, so here we are. This is the second lecture on the introduction. We're going to finish up the introduction today, and then next time we'll get into chapter 1. And the last thing that we were talking about, and let me see if I get to, let me minimize this and get to, this is the online textbook. And the last thing we were talking about is moral hazard. And to give you an example of moral hazard, now what we're doing here, by the way, in this introduction is that I'm just skipping the surface, trying to give you a flavor of some key terms. And see, what is the name of this course? The name of this course is the Principles of Economics, correct? And now there are a lot more principles than what I present to you with this introduction, but that's really the point to the introduction, is to kind of give you a flavor of these principles that once you understand, then you can, they will aid you in learning really how the world works, at least in terms of economics, all right? And moral hazard was the last one we talked about. If you recall, moral hazard is that when you subsidize somebody, then that somebody is not going to be as careful in making decisions because they don't have to bear the cost of a bad decision. And this is common that big corporations will be involved in what's called rent seeking, where they have hire lobbyists that were usually prior government senators and other legislatures and government people, and they will hire lobbyists to influence legislation that will benefit their business. And that's called rent seeking. And certain businesses have a lot of protection from, let's say, the federal government. Then there is really very little risk to them to make a bad decision, to make a loss, because hey, they don't have to pay the price. Someone else will pay the price. That's what happened in the financial collapse of 2007-2008 when the financial sector failed. It wasn't the businesses themselves that had to pay the cost, but they were bailed out, and that's something else we're going to talk about here. They were bailed out, and essentially it ultimately was the taxpayers who bared the penalty of those bad decisions, not the banks and big corporations. And that brings me to something else. To give you an overview picture, and to give you an analogy, I've been thinking about this. All right, we've got one class here, but we've got two groups, right? We've got this group here in Dublin, and we got the group over there at the mall. Now, let's suppose that this group here in Dublin were the government, and that group over there at the mall were big corporations, especially like big banks. And now you might think, well, these are two different groups. But are we two different groups? Well, we're in two different locations, but we're one class, correct? And I told you that if you're in Dublin, that you can go to the mall, and if you're at the mall, you can come here to Dublin, correct? So we're, one classroom, despite the fact we've got two locations. Well, that's kind of like what it is when you're talking about moral hazard and when you're talking about government and big business. Some people look at government as being one group, and then business being another group. But in reality, for the most part, they are really one group, because it's a revolving door. You've got people from big corporations serving government, then you got people from government after they retire, going back to the corporate, some kind of corporate job. So they're really one group, all right? And you've got to understand that, because a lot of legislation that is passed, goes to benefit this group. All right, well, that just kind of lays the groundwork for what I'm going to talk about. One thing I'm going to talk about here, I've got the Wall Street Journal, as I normally do, and the reason I do bring in the Wall Street is, the whole purpose to this course is that you can understand, when you read something, when you hear something on the news, in terms of the economy, that you understand it. I mean, that's really what this is all about. And I was just reading the other day that they're going to bring back what are called some form of Alt-A loans. Now, we don't really talk about this until the 12th chapter, but an Alt-A loan, there's a nickname for Alt-A loans, and they're called liar loans. And prior to the collapse of 2007, it was legal for one to lie on an application for, let's say, a mortgage. Like if you had a job at McDonald's and you made, $20,000 a year, but if you went to the bank and you took out, you applied for a mortgage and you said your income was $100,000, then that's what they accepted, because that's what kind of loan it was. It's an Alt-A loan. Y'all find that interesting? That it was actually legal to lie on a mortgage application? And they're bringing back these loans, and the reason they're, at least a form of these loans, without getting into any great detail, and the reason, of course, is that with these loans with higher risk also can command a higher interest, a higher return. See? And there are investors out there who are seeking higher returns, so they're bringing back these Alt-A loans in order to get higher returns, like of 8% instead of maybe 2 or 3% with the alternative loans. Okay? Of course, what's the bottom side to this? There's more risk involved, correct? When the default rate on these loans are very high, because there's lots of people who take out loans who can't pay the money back. In fact, there were people back before the 2007 collapse that took out these huge loans and couldn't even make the first payment. I mean, there were people who didn't even move into the house. It was a crazy situation. Now, what's one reason why investors like these big banks come out with these Alt-A loans? Well, one reason is moral hazard. Now, how do we apply moral hazard to this? Because if they take a loss, see, if they loan money to someone and that someone defaults, then ultimately, who's going to pay? Does the bank pay? No, someone else pays. Usually it's the American taxpayer. See? Y'all with me on this? Interesting. Anyway, that's Alt-A loans. Another article here, and something that we talk about later, but I've got a video on it, so I'll do it now. But it's about negative interest rates. See, that comes later here. There's down near the bottom here, there's negative interest rates. But anyway, there they are. But now normally when you put money in the bank, like in the savings, the bank pays you interest, correct? Well, in Europe, with the European Central Bank, and in Japan, and in Sweden, and in Denmark, it's the opposite. If you put money in the bank, then instead of earning interest, you have to pay the bank interest. So like if you put $1,000 in the bank, then it's guaranteed that you may get only $900 back. That's called a negative interest rate. Okay? And there are even in some cases in Europe and Japan where a negative interest rate would, they would actually pay people to borrow money. See, normally when you borrow money, you pay interest, correct? But with a negative interest rate, the bank would pay you to borrow money. Now, does this give you an idea of the wacky world we live in? Yeah.
Now, how does that work? Now, if you borrow
how does that work? That's, you know, he's asked the question, how does that work? I'll let you finish your question, but I knew someone was going to ask me that, and I was prepared for that, and let me just say that I don't know, and I don't know if anybody knows, because it's never been done before in history. All right? See, we are in uncharted waters. We are living in a world that is different than anything else we've ever experienced economically. Yeah, so you want to finish your question?
Yeah, well, I was just going to ask, I mean, like, you know, the whole point of a bank giving out a loan is for them to make money by charging you interest.
Right.
So, I mean, if the bank is paying you to take a loan, that's essentially just robbing the bank in a way.
Yeah, it is, yeah.
It
Doesn't make any sense.
No.
It doesn't make. What he's saying is that normally a bank would lend out money to make money, correct? But now, if they lend out money, they lose money. So how does that work?
So essentially, you can borrow money and put it into your account and get like a wash almost.
Well, yeah, it is. And I really can't explain that because it doesn't really make any sense. Anyway, this is, you know, one reason why economics is so interesting. I mean, it's like it's almost like an Alice in Wonderland existence. Anyway, I got an article here about negative interest rates, which I just said. You know, the European Central Bank is charging a negative interest. The Bank of Japan, Sweden, Denmark, and other countries. Even perhaps the United States in not too distant future will start charging negative interest rates. It says here, Bank of Japan pulled off another monetary surprise on Friday, announcing a negative rate of 0.1% on some bank reserves. By the end of the day, the yen had lost 1.75% in value against the dollar. Now, right away, most people would be lost. You see, the value of a country's currency is dependent upon the demand or supply of that currency on the international market. And when the demand goes down, then the value goes down. And countries want their currencies to fall in value. A high-valued currency is bad economically. A low-valued currency is good economically, which is the opposite of what most people think. And the reason is that when a currency goes down in value relative to other currencies, then their exports become less expensive. And foreigners buy more of their products, which helps that country grow. So countries want, and there's actually something called a currency war, where currencies war against one another, trying to outdo one another to lower the value of their currencies. Okay. Anyway, all this is things we're going to talk about later. But will negative rates stimulate the real economy any more than quantitative easing? Well, quantitative easing is something else that we're, part of this introduction. And what quantitative easing is when the Federal Reserve creates money out of thin air to purchase bonds or perhaps other assets. When the federal government sells bonds to the Federal Reserve, and the Federal Reserve pushes a few keys on a computer and simply creates X trillions of dollars, then that's called quantitative easing. All right? And we can do that because currencies of the world are what are called fiat currencies. A fiat currency is a currency that's not backed up by anything, like the American dollar is not backed up by anything. And that's why we can create it willy-nilly out of thin air, which we have done to a great extent. In fact, that term quantitative easing means the creation of the central bank of new money. Okay? Anyway, that's what quantitative easing means. All right, now in Japan, they have lowered interest rates, and they've embarked on quantitative easing in hopes of stimulating the economy for about 20 years. And every time they do it, things get worse. Now, what do you call insanity? When someone does something time and time again and expect different results, right? And that's exactly where Japan has been. They've been the same. They expect a different result from the same policies. But every time they embark on lowering interest rates and quantitative easing, the economy continues to stagnate. Anyway, I thought that was interesting. I do have a video for you on negative interest rates. Whoops, I did the wrong thing here. Let's see, where am I going? I think you're going to find this interesting.
Imagine Captain Kirk came back to Earth after a 40-year voyage in space. Your job is to explain what's changed in the global financial system while he's been away, starting with negative interest rates. Okay, Jim, here's how it works. You give me 100 euros for this German government bond today, and in 5 years' time, I give you back 95 euros. Any questions? Beam me up, Scotty. They've all gone crazy down here. If you thought it strange that we still have emergency interest rates 7 years after the crisis, you obviously haven't adjusted to the new normal. Not long ago, we all thought the weirdest thing that could happen was central banks printing money and using it to buy government bonds. Those of us who are a bit old-fashioned and belong to what you might call the Austrian school of economics had a technical term to describe what organisations like the Federal Reserve were doing: fraud. Now, QE is part of the new normal. But what happens when the forces of Economics 101, supply and demand, collide with the new normal of biblical money printing? The answer is negative interest rates. You take a risk buying my bonds, and I reward you years in the future by giving you back less than you invested. You think I'm joking, don't you? How does this concept make you feel? Let me do my best to give a rational explanation of something that appears to defy logic. You might want to toke on some wacky-backy before trying to follow this. Because of the risk of deflation in the Eurozone, the European Central Bank recently announced a massive QE program. But unlike the Fed in America...
Now, QE, is quantitative easing. That's what I was talking about. The creation of new money. And when you increase the supply of anything relative to the demand, the price goes down. And the price of borrowed money is interest. So one way of lowering interest rates is to increase the money supply by money creation, which we call quantitative easing. We used to call it monetizing debt, but when that term fell out of favor, we just changed the terminology to make it sound better. So now we call it quantitative easing.
Bank of England here, there's no such thing as European bonds that they can buy. They have to spread their love around, a bit like Mambo number 5. so they have to buy bonds from some of the dodgier countries of southern Europe like Spain, Portugal and Greece. What happens when there are suddenly a lot more buyers for something? The price goes up, which in bond terms means the yield, the interest payment, goes down. So as the bonds of the dodgy countries go up in price a bit, those looking for the safety of stronger countries like Germany or Switzerland will pay even more for their bonds because they're regarded as safe havens. But since their interest rates were already close to zero, this new splurge of buying has raised the price so much that the yield has gone negative. This is something many economists thought could never happen. They talked in hushed tones about interest rates being zero bound. Like so much, the economists tell us, this has proved to be utter BS. Switzerland started it with a central bank rate of minus 0.25% in December, and they've since raised the negative rate to 0.75%. The ECB has followed suit and is now charging banks to leave funds on deposit. And it's not just banks and government bonds going negative. In recent weeks, corporate bonds issued by the likes of Nestle and Shell have also gone negative. So, in their search for what they perceive as safe investments, individuals and institutions are now prepared to take a guaranteed loss over periods of up to 13 years in the case of Swiss government bonds. Madness, or a certain sign that there's mayhem on the horizon? If you haven't already booked your seat at the Wealth Summit to find out what the best brains on the planet think is going to happen, be very careful out there. You've got your head in the sand, taking no interest in the election battlefield. Be very careful out there.
Let's see. Well, did y'all find that interesting? This is a strange world that we live in. You know, the world that you're growing up in is so different than the world I grew up in. All right, so the Laffer curve. Let me explain to you what some of these terms. If what the Laffer curve shows is that if taxes are zero and the government institutes taxes, then what's going to happen to government revenues? Well, government revenues will go up, correct? The taxes are zero and we, institute a low tax, then the government receives more tax revenue. And we increase taxes, the tax rate, then taxes will increase again. The government brings in more money. We increase taxes, the government brings in more money. But is that true ad infinitum? Is that true? I mean, is it true that every time the government raises taxes, that tax revenues increase? And the answer is no, it's not. Because of what is called the Laffer curve, if you increase taxes beyond a certain point, then tax revenues will go down instead of up. Why is that? Well, because if you increase taxes beyond a certain point, then you get something called tax aversion. You'll get people who will either legally or illegally do what they can to avoid paying those higher taxes. You see, most people, including corporations, don't mind paying taxes if they think those taxes are reasonable. But once taxes become unreasonable, at least in the minds of the payer, and they become a great burden on the payer, then people who pay taxes are going to take action to try to limit to their tax payments. And when they do that, when they make decisions, that decision may simply be, hey, if I get a job and most of what I make just goes taxes, I just won't get a job. So what happens is that tax revenues go down as tax rates go up. All right? Anyway, that's just a principle. And that brings us to the concept of inversions. Now, what an inversion is that we live in a very how you say, well, we live in a world where big corporations are multinational. What that means is that they have businesses in several different countries. Now, a big corporation may have their home base in one country, like America, but they might have, parts of their business, in fact, maybe even big parts of their business in other countries. Now, we have a law in America. Well, first of all, America's got the highest corporate tax rate in the world, number one. And number two, we are the only country that if an American company owns income in a foreign country and they bring that money back to America, then they owe taxes on that money. Now, the problem there is that they also owe taxes to the country that they earn the money in. So, for example, if you're in Scotland or Ireland, and you're an American business and you earn an income, then you owe taxes to the Scottish or the Irish government. And then when you bring that money back to America, then you also owe the American government money, taxes. So you're taxed twice. We're the only country in the world that does this. So because of these two things, because the American corporate tax is so high, higher than any other country, and because we are the only country that taxes income made in foreign countries, again, it's a double taxation. There are many American companies who are saying, why should we have our domicile in America if we can move our base of operations to that foreign country? And we call this inversion. There are many American companies that have bought either foreign companies or companies that bought them, but they have merged with foreign companies, or at least moved their operations to that foreign country so that they can be considered no longer an American company. And therefore, they get out of paying these very high taxes of the American government. And we call this inversions. And inversion is a relatively new concept. I mean, it's something, it's a reaction to the high tax rate in America. So many American companies are, moving their home base into foreign countries. Anyway, we call that inversions. Now, how does what is an inversion example of? An inversion is an example of the Laffer curve, right? What's the Laffer curve? The Laffer curve says that if you raise taxes beyond a certain point, tax revenues will go down. So what do inversions do? When American companies move their base of operations to a foreign country and therefore pay less taxes to the American government, what is that an example of? Well, that's exactly what the Laffer curve explains. You raise taxes beyond a certain point, then tax revenues, in this case for the American government, will go down instead of up. And that's what's happening. Okay, stock versus flow is another concept. There are two ways of looking at things. If I say that the American government raises taxes by, let's say, 10%, then you might say, well, if the tax rate goes up by 10%, then people will pay 10% more. All right? Now, that may be true in terms of the short run, or in terms of looking at it as a stock situation. But if you look at it as a flow situation, then you get a different result. Because if you look at it as a flow situation, you say, okay, if the government raises taxes, then does this change the behavior of taxpayers? If it changes the behavior of taxpayers, like more inversions, then when you raise taxes, tax revenues go down instead of up. So when we're confronted with economic situations, if we look at it as a stock situation, we may come up with one conclusion, but if we look at it as a flow situation, over a period of time where we get a cause and effect, A affects B, and then therefore B affects C, and then C affects D, and on like that, we get this dominoes effect. When we look at it as a flow situation, then we get a totally different outcome, okay? Now, when the federal government makes decisions to raise taxes, do they look at it as a stock situation or a flow situation? They always look at it as a stock situation. Their models, their economic models say that if they raise taxes by 5%, that government revenues will increase by 5%. But is that realistic in the real world if you look at it as a flow situation? And the answer is no, it's not. So you got to be aware of that. When we're analyzing economic events, you got to be aware of, okay, is this a stock situation, or am I going to look at it as are we analyzing it as a flow situation? All right, economies and diseconomies of scale. Economies of scale means that as a business grows, there are all kinds of ways that the business can lower costs. Okay, like if a business grows, then it can better use its byproducts. An example I like to give is if you're a small farmer and you've got, let's say, only a couple acres of land, then you may use a small tractor on those couple acres. But if you have 1,000 acres, then maybe you can justify buying a large, modern, more efficient tractor. Now, a modern large tractor is going to be more efficient than a small, inexpensive tractor. So a big farmer can lower costs by using this very large tractor. Now, why can't the small farmer use that big tractor? Because it wouldn't make sense cost-wise, right? I mean, if you're a small farmer, can you justify spending a couple $100,000 on one of these modern tractors? Well, it would make no sense. As a small farmer, you're just going to use the small tractor. So this is just one example of how, as a business grows, you see, there are all kinds of ways that this business can lower costs. And we call this economies of scale. Now, diseconomies of scale means that if you grow beyond a certain point, then your costs may start to increase instead of decrease. And this usually happens because when things become more bureaucratic, then the wheels and the communication between the different parts of the organization begin to break down. And therefore, as you become more bureaucratic, as you grow in size, then your costs at some point may start to go up instead of down. And if they do, then we call this concept diseconomies of scale. So there are economies of scale and there are diseconomies of scale. Now, which form of business would be in favor of more government regulations? Big business or small business? And the answer is big business. Why? Because big business enjoys high economies of scale that a small business doesn't. So if we have more regulations, who can afford those regulations better, the big business or the little business? The big business. And can these increase of cost drive the little business out of business? Yes. And is that a benefit to the big business? Yes, it is. In fact, that's part of the game plan. See what I mean? I mean, you got to think about this. You can't. The point I'm making is that you can't look at business as just one unit. Okay? There's a big difference between a small business and the big business. And the big difference is economies of scale. Big businesses enjoy huge economies of scale, which enables them to afford to meet certain government regulations and to pay higher taxes, which may actually benefit them because the high taxes and the greater regulations minimizes competition. Does that make sense? See, what I'm trying to do here is that not only am I presenting to you these concepts, these principles, but I'm trying to give you just a flavor of how we use these concepts to understand what's happening in the world economically. That's really the whole point to this. All right, equilibrium. Now, equilibrium is a very important concept in economics. Very important concept. An equilibrium means a tendency toward. An equilibrium doesn't mean that two things are equal. It means that that there's a tendency toward a certain point. Okay? So in economics, we often talk about the equilibrium. Like, for example, do we have full employment at the equilibrium, or can the economy tend toward a point of less than full employment? Now, this is a big difference between the Austrian view of economics and the Keynesian view. The Keynesians believe that it's possible for us to tend toward a point of less than full employment. And therefore, in those situations, we need big government to shift the equilibrium to a full employment equilibrium. Whereas the Austrians believe that if you have less government and fewer restrictions and regulations and lower taxes, that the economy will tend toward a point of full employment. Now, if you're tending toward a point of full employment, that doesn't mean that you're always going to have full employment. There may be times when you have unemployment and times when you have full employment. Things get better and things get worse, but the tendency, if you believe that the economy is tending toward a point of full employment, the tendency is for us to move toward the point of full employment. Okay? Big difference between, through this textbook, through this course, we talk a lot about, differences between the Austrian way of thinking and the Keynesian way of thinking. And one of the differences here is that the Austrian way of thinking believes that in a free market, we will have a full employment equilibrium. Whereas Keynesians say, well, that's possible, but it's also possible that we could tend toward a point of less than full employment, and when that's the case, we need big government. Big difference between Austrians and Keynesians in this concept of equilibrium. Negative interest rates, I just talked about, but negative interest rates are related to bailouts and bail-ins. Again, this is new territory, all right? This is the new world that we live in. Now, what happened, in 2007, 2008, our financial system collapsed. And who bared the brunt financially of the collapse? Well, it was the American taxpayer. Because the federal government bailed out these big corporations, mostly the big banks. See, the government took billions of dollars to bail out these corporations. That's called a bailout. Okay? Now, if that's a bailout, what is a bail-in? This is where things get interesting. Let's say that you have savings in the bank, and the bank has made some bad decisions. Maybe they've taken high risks, maybe with too many Alt-A loans, and so they lose a bunch of money. Well, who's going to make good on that money? Well, the bank looks at depositors as investors. In other words, legally, when you put money in the savings, that money no longer belongs to you, it belongs to the bank. So what a bail-in is that the banks take people's savings to make good on the losses. So instead of taxpayers paying for the losses, now you've got savers or people with money in banks paying for the losses. And that's what's called a bail-in. And this is already occurring in some countries in Europe. Some countries have already experienced, savers have lost their, I was reading about one guy who committed suicide because he had a bunch of money in the bank, and the bank simply took it all because they needed the money to make good on some bad investments. That's called a bail-in. Yeah, y'all find this interesting? A couple years ago, there was no such thing as bail-ins. A couple years ago, there was no such thing as negative interest rates. See, there's a relationship between bail-ins and negative interest rates. See, when a bank embarks on negative interest rates, well, who's paying for the costs of the bank? It's the saver, right? If you put $100 in the bank and the bank only guarantees you back $90, then that means the bank has taken that $10. Well, if we have a bail-in and banks raid the savings accounts of savers, then it's really the same thing. See, there's a direct relationship between bail-ins and negative interest rates. Now, bail-ins they're certainly not common. Negative interest rates are not common, but they are increasing because we are entering into a whole new economic world, all right? Things are happening today that have never happened before in history. And I'm giving you a flavor of some of these things. Some of the, trying to give you an idea of what kind of world that you're a part of. Disparate impact. Here's an interesting concept. If you're a financial, let's say you own a bank or something, or let's look at banks. Do banks have to do anything wrong in order to be penalized? And the answer is no. That they can be penalized, and when I say penalized, that means that they would have to pay huge fines, all right? You can be penalized for not doing anything wrong. Now, how is that? Well, this is where disparate impact comes in. Let me give you an example of disparate impact. What what the government has done is that they'll look at a bank and they'll ask themselves, is this bank being discriminatory? Is this bank favoring one group over another? Now, how are we going to ascertain if this bank is discriminating? Well, what we'll do is that we'll demand information from this bank, and we'll look at all the people that have taken out loans from this bank, and we'll look at the people's last names, and we'll look at where these people live, and we will come to a conclusion with this information if the bank is being discriminatory or not. So if we have this information and we say, well, a Smith, well, maybe, that sounds like more one ethnic group over another ethnic group. And this person lives in a certain area, and so we kind of think that they're this ethnic group or that ethnic group. And we demand that a bank has to take so many percent to loan to this ethnic group, and so many percent to this ethnic group, and so percent to males, and so many to females, and so many. You see, a bank has to meet all these government regulations. But if the government says, well, according to disparate impact, even though no one has made a complaint, we're going to put this big fine on you, and we're going to charge you with discrimination. Again, new world concept. Disparate impact. That's a new concept. After maybe 3 or 4 years ago, it didn't exist, but now it does exist. Okay, buying shares of stock on the margin. I think we've already talked about this, right? When you buy stock on the margin, that means that you borrow money from your stockbroker, and when the value of that stock goes down, then the broker may issue what is called a margin call, which says that because the value of your stock has gone down, the broker says you owe me the money that I lent you. Okay, that's called a margin call, and that is related to marketing to market. Now, did I talk about this last time? I forget. The concept of marking to market accounting. Marking to market accounting is one of the reasons for the financial collapse of 2007, 2008. What market to market accounting says is that a financial firm, or like a bank, has to put on their books the value of their loans or their equities to the market, and not to, in other words, let's say someone, this is related to buying stock on the margin. Let's say that you buy $10,000 worth of stock from, you buy $10,000 worth of stock and you borrow, let's say, $500 from your stock, or $5,000 from your stockbroker. You buy $10,000 worth of stock, but you borrow $5,000 from your stockbroker. So the value what that bank, what that broker has on his books is $10,000. Now, if the value of that stock goes down in the market to maybe $7,000, then marketing to market accounting says that the broker has to reevaluate its accounting books, and it cannot value those stocks at $10,000, but it has to revalue it at the lower price, at maybe $7,000. Now, why did this contribute to the financial collapse? Because if once things start to head south, and if everyone is revaluing their assets according to market accounting, then that leads to more and more margin calls. And with more and more margin calls, what happens is, well, person A can't make their margin call, so they have to sell their stock or other assets in order to get the money, but then other people can't make their. It's a dominoes effect. See, and anyway, market to market accounting is something we're going to talk about later. A derivative. We're actually getting near the end here. A derivative. A financial instrument which derives its value from some underlying asset. Now, we talk a lot about derivatives later in the book. Again, I'm just hitting the highlights here. But the derivatives market is the largest market in the world. It's over a $600 trillion market. Now, what in the world is a derivative? Well, it's very simple. Very simple. I'll give you an example. Let's say that here I got this piece of paper here, you see, and you and I are going to come together and we're going to make a bet. And I'm going to say that on May 1st, the sun is going to shine. And you say that on May 1st, in a couple months, that it's going to rain. And we wager, let's say, $10,000. And we write on this piece of paper our agreement. I say the sun's going to shine. You say it's going to rain. The loser pays the winner $10,000. And we sign our names to it. Now, whoever owns this piece of paper and who is on the winning side of the bet will collect $5,000 May 1st. Now, this piece of paper is now what is called a derivative. See, does this piece of paper have any value in and of itself? No. But it has value. Why? Because the value is derived from the bet that you and I made. Because somebody is going to collect $5,000 at some point in the future. And this is what financial firms do. I mean, this is the largest market in the world. This is what banks do with a great deal of their money. They don't lend it out to people, but they make bets in the derivatives market. Y'all find this interesting? I mean, this is, how we can create. See, that word create means to make something from nothing. And what we're doing here is that we're creating wealth, or we're creating something of value out of thin air, out of nothing. Now, you might think that, my example to you is pretty bizarre. I mean, you and I get together and we simply bet on the weather, at some day in the future. But actually, a lot of bets in the derivatives market are based on things like that. I mean, the most common type of derivative is the bets on values of currencies. Like I might say, you and I get together and we make a bet, and I say that May 1st, the dollar is going to appreciate relative to the Japanese yen. And you say, no, I believe that on this certain date in the future, the Japanese yen will have appreciated relative to the dollar. So that's a very common bet in the derivatives market. The $600 trillion market. So if you don't understand derivatives, you can't understand modern finances, all right? again, it's a relatively new concept. I mean, this is, this new world that we live in. And the derivatives, when we get to chapter 12, you're going to learn that derivatives was a big part of the financial collapse of 2007, 2008. Okay, anyway, a fiat currency, we're just about done here. A fiat currency is a currency that's not backed up by anything. See, all currencies of the world are fiat currencies. That's why countries can increase the money supply willy-nilly because, see, for example, if we were on a gold standard, then the only way to increase the money supply would be to increase our holdings of gold because money would have been backed up by gold. But if you're on a fiat system where the money is not backed up by anything, then there's no restraint on how much you can increase the money supply by, because it just can be created by pushing a few keys on a computer and crediting an account by X billions of dollars, and then if you, for example, if you went to the bank and you deposited $100 and the teller made a mistake and credited your account by $1,000, could you go out and spend that $1,000, and would that be real money? And the answer is yes. You deposit $100, right? But the teller makes a mistake. They put an extra zero on it. They credit your account by $1,000. Can you go out and write checks against that $1,000? Will those checks be honored, and is that real bona fide money? And the answer is yes. Now, in reality, the bank will probably find out that they're a mistake, and they'll say, well, hey, we made a mistake, and, you owe us $900. But the point I'm making is that once that teller pushed another zero on the computer, $900 was simply created out of thin air. And this is what happens with fiat currencies. Now later we're going to talk about virtual currencies like Bitcoin. And the big advantage of virtual currencies like Bitcoin is that they cannot come into existence willy-nilly like official currencies are. That virtual currencies, to have value, have to have a restraint to where they can come into existence through only a very prescribed format, which is the reason why many virtual currencies actually have more value than national currencies. There's a movement away from national currencies like the American dollar toward virtual currencies like Bitcoin because of this difference that I'm talking about. Yeah, y'all find that interesting? Anyway, that's the fiat currencies. Every nation of the world, their currency is a fiat currency. In fact, there are some economists that won't even call the American dollar money. That the American, yeah,
Another question.
yeah.
How is the government going about taxing Bitcoin?
Oh, it's not government. No government has virtual currencies. This is private. There's a fella in Floyd County that's got his own virtual currency that's being used in this area. Anybody can come out with their own virtual currency, and as long as people accept it, then that's how virtual currencies work.
But isn't won't that be considered illegal in a sort of way?
Now say that again.
Isn't virtual currencies almost illegal? And say how would the IRS collect tax you money? I don't know. How is
That's
government
a, boy. That's
going
yeah.
about
That is an excellent question, and I wish I really could answer that. I mean, I wish I had enough knowledge, to answer that question in full. I do believe, and I'm not an expert at this. And again, this is, I'm in some respects, I'm like you. I mean, I'm kind of like learning this stuff as I go along myself because so much of it is so brand new. But I do believe that even though you use a virtual currency, that if you make a profit, that there there is I do believe that this is still taxable. But again, I mean, this is. I wish I could answer it in that question because it is a very good question. But virtual currencies are not illegal. In fact, they are being used more and more. They're becoming more and more popular around the world. A virtual currency is not of any one country. It is a world, international, any virtual currency, and there are many of them. Bitcoin is one that is very well known and maybe being the most popular. But there's no country. People can use money can be anything that people agree that it has a certain value, and they're willing to exchange goods and services for this currency. I mean, as long as people are willing to engage in buying and selling using whatever, I mean, it could be,
Could be along the lines of trading.
yeah, well, it could be anything, I mean, money has been, in prisoner of war camps, for example, tobacco was used as money. And in the early colonial days, in fact, before there was an America and before we had our own currency, tobacco was used as currency. I mean, anything can be used as money as long as people will agree to it. And the fact is that many people are agreeing to buy and sell amongst one another using some virtual currency like Bitcoin. Now, again, what I'm doing here is I'm just touching the surface of all these things. We've just spent 2 periods it's like I'm throwing a flat pebble across a steel pond, and we're kind of skipping and not going into any of these things in great detail. But everything that I've talked about in these past 2 class periods, we're going to talk about, later, and we're going to use these concepts to explain. In fact, we'll use these concepts over and over again to explain how things work economically. All right? And that brings us to the last one, and I've already explained what quantitative easing is. Quantitative easing is a term that the government invented because we used to call it monetizing the debt, but when that fell out of favor, we invented the term quantitative easing to make it sound better. But it's the idea of creating money. Now, can American government create money? And the answer is no. Our U.S. Treasury cannot create money. That's not the role of our U.S. Treasury. Who is the only institution that can create money? The central bank, or in our case, the Federal Reserve. And the Federal Reserve is not a part of the government. It's separate. Even though we call it federal, that name is misleading. First of all, it's not federal, and it doesn't hold money in reserve. So the whole, name of Federal Reserve is very misleading. But the Federal Reserve is really controlled by private individuals. It's a private institution that has a partnership with government, but it's not a part of government. In fact, its books have never been audited. Okay, according to the rules of the Federal Reserve, no one can audit the books, not even the federal government. because it's totally separate from the federal government and it's private in many respects. But yet that institution is the only institution that has the authority to create money. See, it creates money out of thin air and then lends that money out to people and charges interest. Now, y'all find that interesting? Now, if you were in a position to create money out of thin air, then why would you simply be satisfied with creating money instead of going through the process of lending money out? That's an interesting concept. And the reason is that if you create money, then you may be able to buy things, this, that, and do things, but it's really not about money, it's about control. When you lend that money out to somebody and charge them interest, and if they can't make good on that payment, then you can confiscate their property. Is that what happens? If you borrow money on a house and you can't make your payments, after a while, what does the bank do? It repossesses the house. Well, that was really the whole point. And in the meantime, the lending institution has some control over you because of the threat of you losing your property. And that's the whole purpose of the Federal Reserve. Money is created and then lent out, and people are charged interest on this newly created money. And that's the way the system works. Now that's interesting. Yeah, you had a question?
Yeah, now quantitative easing, I don't know, I'm kind of like, I don't know if I'm fully getting it, but I just want to ask a question about, I feel like it's kind of like. What was your question?
Well, I'll repeat it once he asks it. Go ahead.
But, no, when the mark fell in Germany, back in the I think it was the 40s?
When the mark fell in Germany.
Yeah, was that because of quantitative easing? Because I know at the time that the mark to.
Well, no, in Germany, no. The inflation in Germany in the 30s was the result of newly created money. So you can call that quantitative easing.
Okay.
Now, there may be some difference. Technically, the term quantitative easing means that the central banking authority creates money to purchase something, like, and which is most common, like in America, a United States bond from the government. See, the way the government borrows money is they sell bonds. And when the federal government sells those bonds to the Federal Reserve, and the Federal Reserve creates money to buy those bonds, then we call that quantitative easing. Now, back in the 30s with Germany, I'm not quite sure that was the process. I'm not sure. Again, I'm not a total expert at this. But the point is that in Germany, money was created, but I'm not sure the process was the same. But the money was created. I think back then, the government actually had control over the money supply. See, in our system, the government doesn't have control over the money supply. Our central bank does. But back in Germany in the 30s, I believe the government had control over the money supply, and they simply cranked up the printing presses and created a bunch of money, which caused hyperinflation in Germany in the 30s. And we talk about this, later in the book too, about the German experience. But that's a big cause of inflation. When you increase the supply of anything like money, the value of each unit goes down, so that when you and I go to the store to buy something, it takes more units, and that's what causes inflation. Now, we have a whole chapter on inflation coming up, you see. So, I can't, all these things, you might have questions, but we just got started. I just finished the introduction, and next week we're actually going into, Thursday we'll go into chapter 1. So any other questions over there?
Yes.
Yeah.
Can you hear me?
Yeah.
Okay, you said bail-ins and then interest rates are a new process.
Yeah.
Where's the original from?
Where what it came from?
How how do they come into these?
Well, you know, there's a saying that says, what is that? Invention is a necessity of, how does that go? It just evolved. I mean, well, let me give you an example. Say when the economy collapsed, especially the financial sector collapsed in 2007, somebody had to pay the price. All right, and what was decided is that the American taxpayer would pay the price. See, because there was a necessity there. Someone's got to pay. Now with bail-ins, you know, we're getting a little involved here, but because of the certain laws have been passed that what happened in the 2008 and 2009 with the bailouts has actually been declared illegal. And so, but we have a necessity. Oh, well, there's big losses now here. Well, who's going to bear the price of these losses? So again, you know, we have a great need, and we have to have an answer to the need, and again, it's the American taxpayer, but we're getting to the taxpayer a different way than we did in 2008 and 2009. Instead of the government making the bailouts and taking money from the U.S. taxpayer, we're going to take the money from people who've got money in banks. I mean, it's just it's a result of a need, and that need commands a solution. That's the best I can do. Is that? Any other questions? I'm having a hard time hearing. We're going to have to do something about this communication between us. Are there any other questions? Anyway, we've got the whole rest of the semester, right? I mean, hopefully, you know, this whole thing, and one of the reasons why I encourage you to get involved with the Wall Street Journal is that the more questions you have, the more dialogue we have. Now, I can't promise I can answer every question, but hopefully I know more than you do. See, but the more questions you have, the more interesting this whole thing, this experience is going to be. All right, well, if there's no more questions, it's time to go. Actually, just good timing. So now, what are y'all going to do for next time? Read chapter 1, all right? So we're going to hit the floor running next time and really get into some good stuff. So I'll see you all next time.